offices. And yeah, just this coincides quite quickly with our release of the digital assets report, which will be coming out tomorrow, which is quite exciting. It's going to be available on site to our registered users. Anyone can register for a free account for these reports, and it provides an overview of digital assets for family offices eager to understand more about this theme. So without further ado, let's get started. Excellent. So welcome, everyone. This is our panel for today. We're going to be having quite an interesting topic to unpack what it means for family offices when it comes to digital assets, how they can think about it, and what the approaches are. Obviously, today's conversation is not intended as financial advice in any way. It's more helping family offices to understand and demystify a little bit of what the approach and best practices could be and how to engage with this asset class. I'm going to sort of start the conversation by doing a bit of a whip around and perhaps asking each of the panelists to introduce themselves. So Ben, if you wouldn't mind introducing yourself, telling us a little bit about who you are, where you're from, and relevant for today's conversation.
You bet, Kyle. Thank you. My name is Ben Weiner. I'm the founder and CEO of Dissanayake. I've got some unique work at the South Dakota Blockchain Institute. South Dakota is, as you may know, is one of the best trust states in the country. And so, our focus there is, trying to determine how trustees are able to kind of check those boxes that they have in the fiduciary requirements. So in Dissanayake, we've got a wealth management component where we manage, different hedge funds and custom portfolios. And then we've got Dissanayake custody, helping our clients navigate through that, and then the insurance piece in ensuring those assets in custody.
Brilliant. Perhaps over to Jameson. I'd love to hear a little bit more about you and your relevance for today's conversation.
Sure. I'm the co-founder and CTO of Casa. I've spent the past 9 years working in the Bitcoin and crypto ecosystem, just focused on security and self-custody. And so Casa in particular is a service that helps both people and organizations architect their self-custody. You can think of us as we're consultants to help you be your own bank, because we've seen people make every possible mistake under the sun over the past decade or so, and we can help you navigate and avoid all of the pitfalls in the space.
Brilliant. Amila, I'd love to hear a little bit about you and Chainalysis.
Hello, everyone. So my name is Amila Dissanayake. I'm a lead training specialist at Chainalysis. So Chainalysis, if you're not aware, is a blockchain data platform. So we provide data, software, research, and services to a variety of private and public sector customers. Those applications range from investigation to compliance to market intelligence. And my role in particular is very focused on education. So making sure that people understand the ecosystem that they're entering and how to best use the data that is available.
Brilliant. Thank you so much. Adrian, over to you. It'd be great to hear a little bit more about your background.
Thanks, Kyle. I actually work for a multifamily office, so I'm one of Simple's target audiences, I guess. But within that context, I'm responsible for our alternative assets. And a few years back in 2020, 2021, we came to the conclusion that we needed to have an exposure to what we call the blockchain universe. And within that, of course, digital assets as well. So I've been an allocator within the space for a number of years now. So I sit, I guess, on the top of the pyramid and try and figure out how best and most sober allocate within the space from a family office standpoint.
Excellent. Fantastic. So as you can see, our panel today has a breadth of individuals who really understand the space well from both sides. Perhaps I'll kick off with a very simple question. And ultimately, how would you define a digital asset? So I might sort of pass this one over to Amila, if you don't mind. What should family offices think of when they think of what a digital asset is?
I thought this question might come to me, and so I actually have a definition up in front of me, which is from the Financial Action Task Force. So they're a global standard-setting group, and they're focused on preventing money laundering and financial crime more generally. So they define virtual assets, sometimes called crypto assets, sometimes called digital assets. They're largely used interchangeably, but they're defined by FATF as any digital representation of value that can be digitally traded, transferred, or used for payments. And so there we're encompassing a range of things from cryptocurrencies to stable coins. We might think about central bank digital currencies, CBDCs. You might have heard that term as well. And then, in the wider ecosystem, we've also got smart contracts that might execute financial kind of activities. So we're thinking about the decentralized finance space. So there is, this question seems very simple, but actually has such a huge range of different types of assets that do different types of things. Some do more, some do less. Thinking about, Bitcoin, when it first started, just a very simple idea of peer-to-peer value transfer through to what we see in, say, decentralized finance, where we've got, bits of code living on blockchain executing quite complicated bits of math for us. So yeah, the definition that I always go back to is the FATF one, because that's quite simple and it encompasses quite a lot. But I'm sure some of the other panelists would have a slightly different way of putting it.
Excellent. I love the comprehensive preparation for this as well. Very impressed. 10 points to you. Perhaps over to you, Ben. What would you, if we're thinking about this from a family office perspective, and we're trying to eliminate distractions, what aren't traditional assets? What aren't digital assets? So, we've heard a definition of what it is, but what are they not? How can we sort of cut out the noise from what we're hearing in the papers?
Yeah, it's interesting. I'm not, I don't come from the coding world. I don't speak Python or anything like that. So, when I think of what digital assets are, if you look at NFTs, they are the digital, representation of ownership. So the opposite of that would be just your regular deed, maybe to a home, or the actual physical piece of art. If you're looking at it from the commodity space, Bitcoin is a digital commodity. The physical commodities that we're familiar with are gold and et cetera. And then you have, some digital assets that, have this sort of blend of securities component to it and commodities combined, which makes the SEC's role pretty challenging, maybe. And so, the opposite of that would just be, I think, perhaps traditional equities. However, those can certainly be, digitized as well.
Excellent. That makes sense. I guess if we think of sitting in the driver's seat and you're a family office, perhaps watching this today, why would it be important for them to have a strong understanding of this space? And perhaps I'll sort of pass this one over to you, Adrian.
Yeah, I see digital assets not as a new asset class, but I'm of the belief that all assets in some sort of way will have a digital representation in the future. And if that is true, then everything will have a representation on some sort of blockchain technology. So I guess what family offices really need to understand is, if this is true, that this is a new technology, it's not an asset class per se. It is an enabler for us to digitize the financial world. And if that's true, then we need to really understand the rails and the structure behind the technology as well, which I'm sure that some of the other panelists can talk in a lot deeper depths than I can. But it is really important for me, at least, that we define this as not a new asset class, but of a way for us to efficientize how the financial rails really works.
Brilliant. And Jameson, if we're thinking a little bit about, following on from that, so this is something we're beginning to become more familiar with. It's changing the way we ultimately think about engaging with assets. How will digital assets actually change the playing field for family offices?
Well, it's interesting because I think I'll actually disagree with Adrian slightly. Now, the way that I look at it, so the way that I look at it, and the reason I believe that you may in fact be able to claim that it's a different asset class is because I look at this fundamentally from an aspect of authority. Is what is the ultimate arbiter of truth and ownership of the assets in these systems? And so with most of your traditional financial assets, that means there's going to be some sort of authority, whether it's ultimately like a government or a government approved entity that is keeping track of who owns what within their own databases, their own ledgers. And the revolution within this system is that we've created a new global ledger that in most cases, it gets, there's a lot of gray areas and it gets really complicated. But in cases like Bitcoin, Ethereum, whatever, the authority is comprised of just a large voluntary opt-in group of people who are all running the same set of rules and software. And so, that provides some very interesting attributes. And I think that's why we're all here today, is because we want to convey the power of these attributes and functionality that the digital bearer asset class can give to people. So, what does that mean? Well, it means that you can empower yourself greatly because now you have the ability to take ownership, prove ownership, and transfer ownership of these things, these generally cryptographic tokens that may represent something else of value. And you can do that without asking permission from a third party. You can do that without having to operate within some set of arbitrary constraints like business hours. And you can do it without having to worry about things like jurisdictional rules or having to hop around across different borders. So it's an amazing level of friction, I believe, that has been removed from dealing with financial assets. But of course, the flip side of that, and the reason why I've worked in security for so long, is that it also makes it very ripe space for attackers. And because you're taking on a lot more responsibility, there's a lot more things that can go wrong.
All right, that makes sense. So as we hear, it's an exciting and emergent space. But if we begin to get quite practical in terms of thinking today as a family office who might be less familiar with how to get started, how would you begin to think about recommending a family office begin engaging or understanding a bit more about digital assets today, besides obviously logging into a session like this? Ben, perhaps a question over to you.
Yeah, thank you. I think, having a general understanding of why, what exactly is, what are the motivations? Are the motivations yield generation? If so, there's plenty of opportunities for that. Are they philanthropic? I mean, there's, that's one of the opportunities here is, we view it primarily maybe in the US as investment, but in other countries, it's, substantially different than that. So, I think that's where you start. And then from there, I think it's important to have a really solid understanding of, where you're going to, what sort of entity is going to hold it. If it's a trust, checking with the Division of Banking or, the regulatory authority is, is necessary and takes a little bit away from, what Jameson was saying as part of the advantage. But that's sort of the reality of the situation that we live in now. So just a number of things that you need to consider, just like you were getting into any other spaces. Why are we doing it? Who's advising us? What's the best approach to take? And let's make sure that we have a really sound plan that we're able to execute on before we get started.
All right, those are great principles. I guess sort of piggybacking on those principles a little bit. If we begin to think about, how to really set up a strong foundation and ensure that this is a scalable sort of capital allocation that, can really last and drive lasting value for families. Amila, what would you recommend a family office think about when setting up a foundation for engaging with digital assets? And I don't mean a foundation from a, foundation perspective. I'm a base, shall we say.
So my perspective is always going to come from the risk management side of things. So I think, picking up on what Ben was saying, we need to do due diligence, right? We need a holistic approach to making sure that the people and the services that we're relying upon are competent, trustworthy, liquid, so on and so forth. And here, when we look at the risks that are, commonly associated with digital assets, there's this perception, which I hope is now becoming pretty outdated, that, just cryptocurrency is only used by criminals and it's all just dirty money. Hopefully we can leave that behind in the dust. The stats really don't play that out. But there are, specific concerns that are associated with different types of activity and also different types of assets. So when we look at the kind of macro level, we see that stablecoins are becoming much more popular in the ecosystem, and they have a much bigger market cap now than Bitcoin or Ether. And so here, yes, they're popular. It also means that they're being used more for illicit activity. What type of illicit activities are they associated with that might be of concern to a family office? Well, they're being used a lot for sanctions. So we definitely don't want any connection with sanctioned entities or jurisdictions. They're also being used particularly, if I check my notes here, in scams. So this is another thing I think we would want to be kind of mindful of, both from a investment perspective. So are we investing in the right type of opportunities? Are we investing in a new project, a new token that we think is going to gather value very quickly? Also, if there are recommendations coming from elsewhere, are these people being taken advantage of and exploited, where we see new kind of innovative uses of crypto coming into the market? And one last kind of example here, I think I mentioned decentralized finance earlier. This is such an exciting space. It's really the frontier of innovation within crypto. It is also the place where we're seeing a lot of use of stablecoins, but we're also seeing a lot of different types of risks coming out to play. Historically, last couple of years, we've seen a lot of issues with the code that's being used in the smart contracts of decentralized finance protocols. That risk is now diversifying, and we're seeing a mix of kind of on-chain issues and off-chain issues. So we're seeing the return of classic techniques, social engineering, insider attacks, and all of that kind of stuff. So I think the overall message here is to be holistic, right? Not to assume that there's one type of risk that you need to manage. We need to be looking from several different angles and using the transparency of the blockchain to help us to do that due diligence, because there is a lot more data available to make that assessment, which is the positive note that I would like to end on.
Brilliant. Yeah, I guess sort of taking a data-driven led approach is something that we're seeing quite effectively across family offices at the moment. It's something we've had a webinar on before. I guess, Adrian, if we think a little bit about where there are opportunities for family offices to cut their teeth in this space. If you think back to potentially, when you were thinking about engaging in this space for the first time, without obviously providing financial advice, where are there opportunities to sort of build the muscle?
I think it's very different 2020 to where we are now, because there's a lot more ways to play it now, with also the ETFs coming out. But I think going a little bit off Amila's point about being holistic here, if we're looking towards allocating within the space from a holistic and maybe within a portfolio context, I think that it's prudent to be mindful of how you can diversify within blockchain, because to me at least, it's still a emerging technology, and we still don't know really where it's going to go from here. We obviously have a a clear path that we think it's where it's going, and it's going to impact financial institutions for sure. But I think a diversified approach that's both playing the passive markets on going direct within cryptocurrencies and self-custody. It's also maybe attacking some of the alpha there is around trading, going into a hedge fund like Ben has. But it also might be able to play it from an equity point of view, a traditional private equity standpoint, where you're able to go into different kind of sectors. You were able to invest in Chainalysis way back at a very favorable evaluation. At least now they've become a very, very interesting company within the space, right? So there's many different ways of getting exposure to the emergence of blockchain technology, and I think you need to be diversified, at least if you want a holistic approach.
Right, that makes a lot of sense. I guess, Jameson, if you're thinking about a family office sitting in a world in which they've decided to actually begin engaging in this solution, what are some sort of strategies to get the most out of their digital asset allocation?
Yeah, so kind of piggybacking off of the last question, the first thing I'd point out is that anyone out there who is regularly making international wire transfers should definitely try out stablecoins. I would say they are a 10x, if not a 100x improvement on the user experience in terms of just time and trouble to go through that process. So like I tell everyone that I'm dealing with these days, I'd rather receive stablecoins or send stablecoins than bother with wire transfers. Now, on the sort of dipping your toes into the ecosystem, obviously I'm a tech guy. I look at all of this stuff from a protocol and a game theory perspective, and there's a few different ways to approach it. I first generally break it down between, is this token or project a sort of open, collaborative project that a bunch of different diverse people are working on, or is it looking more like a company and a small startup? And I would say the vast majority of projects in the space are more like small startups, and they should be approached from more of an angel investment or venture capital type of approach of like, you need to be doing a lot of due diligence on the people behind the project, not just the technical claims of what they are saying they're going to do. Because, it's easy to come up with ideas. It's hard to execute. Also, I think it's very important to recognize what are people actually doing when they are creating new tokens and projects in the space. They are literally creating new games. They are codifying rules of a new system. And this is where it can get very difficult to try to evaluate the risk, is because if you aren't very technical or you don't have very technical advisors, then you may only see the rules of the game that are being marketed to you. And this is why so many scams in this space can be so popular, is because a lot of people don't look under the hood to see what are the actual rules to the game. So that's the main thing that I would encourage people to be very wary about.
Brilliant. Good watch outs. Was that Ben? Sorry.
Yeah. Can I chime in on that just for a second?
Great.
Yeah, I think that there's there's a perception out there that the way that you invest in this space is to buy a token or asset and sit on it and wait and then sell it in the future for more yield. But I think for money managers, for wealth managers, there needs to be a realization that there are so many different strategies in this space that mirror traditional strategies. You can have a correlated strategy, an inversely correlated strategy, a non-correlated. So, picking up or assuming a strategy that can get you, if we're trying to get somewhere between that, 10 and 12% yield with low risk. I mean, there's certainly ways to do that. And I think, one of the things people don't realize is that there's probably more yield with less risk in this space than in the traditional space. likely because it's emerging and not everybody's playing in it.
All right. And I guess that quite nicely leads on to the next section. So if we think about a family office, you know, they are as different as you might expect them to be, and broad and diverse, but ultimately they traditionally come from a background where they're asset managers, or, you know, they've built the wealth themselves. But they're sitting in a position now where there's a whole new world, an ecosystem that's coming to the fore. What that means is they need to tap into some expertise, service providers, to understand how to navigate this space correctly. So I guess maybe I'll start with yourself, Amila. If we're thinking about a family office trying to actually engage in this new frontier, we know sometimes it can be a bit wild out there. What should they be doing when they think about sort of doing their due diligence to ensure that they're sort of set up for success?
So I think this comes back to what we were talking about previously in terms of data. So the big difference for me when I compare working in the fiat space to working in crypto is the availability of data, right? The blockchains, by and large, with some exceptions, but by and large are transparent, right? And that gives us access to a lot more data than we have available in the fiat world. Now, this is not the be all and end all. I wouldn't suggest that anyone solely relies on blockchain data when doing their due diligence and choosing providers or experts, but getting hold of that data, and if you need someone to help you to pass that data, to interpret it, then so be it. But getting hold of that data is going to be a really, really important component that perhaps isn't so much the case in the fiat world. And for those of you who are perhaps not as familiar with what that means in terms of data, like what am I talking about? Is this just like a black box of like magic there? When we're thinking about blockchain activity, we're able to see transactions. So we're basically able to see a version of a ledger where movements of funds are being recorded for everybody to see. Now that may sound amazing to some of you, and it may strike fear in the hearts of others. I know there is generally a pretty mixed reception to this idea, but that data on a positive side of things allows us to do better due diligence, and it allows us also to compare what a service provider might be telling us with what we can see on chains. Do those two things match up? Where are their funds coming from and going to? Does that match with what they say in terms of the types of suppliers that they use, the types of customers that they have, the types of services that they provide, the types of assets they support? All of these things can actually be checked independently without going through some sort of invasive process. It's out there, publicly available information that we can check. And then further, if we think about what the type of blockchain analytics companies do, like Chainalysis, for example, we are in the business of analyzing that data to provide further insights. So can we figure out, for example, on many blockchains, we're not able to see who exactly is conducting a transaction. We call it pseudonymous. It's not quite anonymous. There are some identifiers there on the blockchain, but it doesn't say, Amila sent these funds to Kyle. So we are sometimes able to identify large services who are interacting in this space. So we're able to provide even more insight based on that publicly available data. So that information is a big differentiator. And as I kind of mentioned a couple of examples there, used in combination with other things that you're getting hold of and the conversations that you're having, I think that's the big piece when it comes to due diligence, is using that publicly available data.
Brilliant. So we've got some interesting questions in the chat, which I might begin to just sort of cycle through. And that was a fantastic sort of steer to some of these. So I guess we have one from, let's look at Richard first. So we've got one from Richard Lewin. So how can a family office articulate its commitment to crypto when engaging and developing or updating a meaningful vision? So how should they begin to think a little bit about this, tying their vision to the crypto side of things? And perhaps this is something I'll throw this towards, let's start with you, Adrian.
Yeah, I think it really depends on how you look at it. Do you look at it from a principal standpoint, or do you look at it from the wealth owner behind the family office? Because those might be two very different things, and I can only answer from managing the money and not being a wealth owner myself. But from our perspective, if we're trying to be a family office who is on the forefront and are trying to preserve wealth in the long run, we need to be able to look at new technologies as well. And if we're preserving wealth for the long run, we need to invest in the new technologies as well. And blockchain and digital assets are certainly that. So you might think that the rest of your portfolio might be impacted by not having an exposure to this as well, because it could potentially disrupt some of the other companies or other allocations that you have in your portfolio. So looking at it as a holistic diversification is the way we articulate it internally anyhow.
Excellent. Great answer. And I guess another question. So LinkedIn user here has sort of hidden their name, but I think the question is quite interesting. So, how should family office begin to think about sizing their positions when they think about digital assets? So perhaps maybe to you, Ben, this probably goes back a little bit more to how dipping your toe into the ecosystem. How do you begin to kind of think about beginning to size out how much you're sort of exposing yourself to this asset class?
Yeah, I mean, I guess it depends on what the strategy is. If you've got right now a 70-30 blend of like equities to fixed, right? Well, there's different strategies within that fixed component that you can that you can have in the digital space, in the crypto space. So you could say, for example, if you're looking at a fixed income or a high yield, at potentially taking some of that and diversifying it. If it was just a single asset, I think all of us here love Bitcoin and would say all of it. No, I don't think that you're going to put any more than a few percent in any one particular basket. But I would challenge them to look at their correlated, non-correlated, inversely correlated strategies and visit with somebody to say, can we do this same thing in the digital space and potentially have less risk and get more yield? So that really takes your diversification exposure up from 1 to 10%, potentially much higher than that.
Right, makes complete sense. So perhaps sort of jumping back to the service provider piece, I think if we think of sort of typical service providers that a family office should begin to think about having on speed dial for this type of asset class, who would you typically want to reach out to first? What's the sort of profile of an expert or an advisor in this space? Perhaps I'll start with you, Jameson.
Well, from a security perspective, you're going to need to find a custodian. You'll also need to determine whether or not you want a custodian that is handling everything for you. And in that case, they're probably going to charge for institutional custody like 10 to 20 bips. You're taking a slice of those assets. Or if you look at one of the self-custody options, that will end up being a lot cheaper for you, but of course you're going to be taking on more responsibility and having to manage keys yourself. Interesting trade-offs there, of course, and I'm very biased on the self-custody perspective because I think that you're also empowering yourself to be able to deal with these assets without having to ask permission from some third party. But it's also tricky if you're looking for sort of technical analysis, digging into newer protocols, tokens, understanding all of the risks and rewards. I think most custodians are not going to provide that level of strategy. So that's where it gets trickier, and you have to sort of reach out into the space and find Really, I would call it more of a longevity thing. The people and the services that have been around for less than a full market cycle, you should be much more suspicious about. That's the only sort of broad way I can describe how to be more sure that you're going to be talking to a reputable person or provider, is the people who survive, full market cycle, like four-year cycle in this space, are less likely to be scammers, less likely to be doing malicious things, and that's generally because you end up blowing up if you're not on the up and up.
Right. So there's a question from Jason Pinkham, which I guess is similar to this as well. So if we imagine, he's curious about how the process of a single family office decides to officially invest in, say, digital assets. Once this decision is actually made, what's the approach to this implementation? And I guess who do they need, and how do they begin to actually kick off this process? What type of service providers are they looking at? What type of experts might they need to tap into? And I'll sort of direct this one towards you, Adrian, again.
Yeah, I guess if we're just talking about investing in digital assets, let's say just define that as Bitcoin or some of the other top tokens that are out there. You need to decide if you want to self-custody, which ethically I agree with Jameson. It's probably better to self-custody. From a practical standpoint, I guess with the success of the ETFs, it's another question. So you need to first think about, do you want to custody it yourself, or do you want to find a custody provider? Going off Chainalysis and all that they're doing, you need to have some kind of data and some kind of solutions around data. You can go to Token Terminal, which is similar to a Bloomberg, or find stuff there. And then lastly, I would say, if we're just focusing on the trading aspect, either you need a trading partner that can handle the trades for you, or if you just want to do it passively, you need to also think about how can you actually implement this and just sit with it. From our standpoint, there's a lot of alpha within the space if you're able to do sort of what also Ben is doing with their hedge funds. So and a passive allocation to this can be very beneficial, but you are also able to create some kind of alpha. At least that's what we've seen in previous cycles.
Right, brilliant. And I think, Amila, perhaps a question for you as well. So there's, I guess, those first degree of service providers. So we think about, the asset allocation itself, but then I guess there's the infrastructure partners behind that, much like Chainalysis. It would be interesting to hear a little bit more about, who should you have in your ecosystem if you're thinking about getting into this space?
Yeah, I think I don't want to repeat what the other panelists have said, because I agree fully. And I would also like to put my hand up for the self-custody train. I think that is the principle of the thing that we're getting involved in. But I think it is, it also is about making sure that you have access to the type of analytics that you want, so that you can think about what tools that you need to kind of review your portfolio. Sorry, if I can get my words out, and how that's acting for you. Particularly if you are directly investing in a number of specific assets. Obviously, we talked earlier about how there are different ways that you can get exposure to the crypto ecosystem, and some of these are going to be more passive, and then more traditional tools might be sufficient. But from a kind of direct investment point of view, I think having access to that data, whether it's blockchain analytics, publicly available data, and making sure you know how to use that, because it's all very well saying, oh, I have this data stream, or I can go here to get access to this information, but how are you actually going to use it? How are you embedding it into your processes and your policies to make sure that it is being utilized and it is being used to manage risk?
Brilliant. So I guess I might sort of throw this one over to you, Ben. If we're thinking a little bit about family offices having to think about managing the cost of this thing, what type of typical costs come into beyond just capital allocation, having the asset, all of that sort of thing. What unexpected costs might there be?
Great question. There's a number of different ones. I'm going to start by saying, I love what Jameson is doing. I think self-custody, everybody will agree with that. That's not always possible. Especially if you get into, some of the trustees and their comfort level with handling things. And, the other thing that I would say, so, I mean, you potentially have, the cost of custodian there. Another cost that we talk about all the time is that if you're not in the space or you haven't been in the space, I think all of us on the panel can agree that we've all paid a tuition. It's just kind of the way it is. And if you haven't, you're probably not trying. We're, in any emerging market, you're going to get burned from time to time. And I'm sure we all have here. And so if you're going to take it on yourself, I think what you try to do is reduce the tuition that you have to pay. Right. And so sometimes that'll come at the cost of, performance fee of a hedge fund or, an advisor. I think those are, probably the biggest ones that we would focus on.
Great. Brilliant. So I've had another question come through in the chat from Christina Varga. When looking for service providers, specialists, advisors, etc., in this space, do you look locally? For example, they cover the Canadian family office space, or can they look a little bit more international? Perhaps that's a question I'll sort of hand over to Adrian. What are your thoughts on this? Do you need to, you obviously serve the Danish market. Do you want to look at providers in your sector and space only, or are you looking globally?
We're certainly looking globally. I think this is a global space. If you're not trying to go with the best service providers around the globe, then you have a higher chance of risk, and you have a higher chance of also not executing on the strategy. So I would certainly go towards the biggest players within the space, or at least the established ones. I think Jameson made a good point. If they haven't been around for a full market cycle, I think it's a bit concerning at this point. And there's certainly a lot of different service providers who have been around for one or more market cycles.
Brilliant. So I guess, go ahead, please.
On that, I totally agree with that. I think there's one exception, which is thinking about your compliance requirements. So these vary so wildly from jurisdiction to jurisdiction. So that's the only one where I feel like a local expert might be more useful, because there's just so much variety depending on where you are in the world.
100%. And I guess regulation actually moves quite quickly in this space compared to a sort of traditional regulation. So a question here as well, moving on to, where this market is today. So say someone's woken up from a slumber post-COVID and they've stumbled into this webinar. How mature would you say the market is? And that's obviously a philosophical question. And perhaps I'll kick that one off with Ben here at Grid.
Fairly immature. As fascinating and amazing as the technology is, I think we're just getting started. We talk about S-curve in technology and the amount of time that it takes to go from 0 to 10% adoption. You get takes the same amount of time to go from 10 to 90 roughly. I think we're just turning the corner in that. And I think the reason that I would say that is we still haven't seen, from a decentralized application standpoint, much of what I anticipate will be built. So are we in the late 90s, 2000s of the internet? I think probably close to that.
Great. Perhaps a flow over to you then, Jameson. Where do you think we are in the current cycle then?
Yeah, it's early from a variety of perspectives, and this becomes trickier and trickier for me to fully understand because I've been in the space so long. It feels like 100 years. Things move so quickly. It's very easy to sort of compress the history of everything that has happened in your head. But when you go out on the street and you talk to the average person, they're probably not going to be able to tell you very much about any aspects of the crypto ecosystem. So there's definitely still a lot of opportunity for people to get in early and start experimenting. The flip side of that, of course, great risk as well. And that's why there still is a lot of opportunity, because you have to be able to navigate this space and not get blown up. And so, there's still a lot of work that need to be done from security, scalability, privacy. None of these systems are really ready for mainstream adoption, I believe, from a technical perspective. And so what we're going to continue seeing is, I believe, these market cycles where we get a new wave of adoption and then things start to break and people get disillusioned and leave the space. And then the builders like myself keep building. And that cycle, I think, is going to continue repeating for the short to medium term. The main thing that I would caution people in terms of risk, if you're getting into this space, I think that it is a lot safer to be more passive and look at sort of long-term holding perspective of tokens, because the more active you get in the space, the more frequently you are interacting with these protocols and using private keys and making trades and doing DeFi stuff, the more risk you expose yourself to, because you're getting more exposure to new code, new rules, new smart contracts, and basically the places where all the dragons still are. So obviously there's more risk there, more reward there, but also much higher potential to lose everything when you're dealing with the much more new and emergent behavior.
Yeah, piggyback off of that, Jason, or Jameson, I think, what's kind of interesting is in these cycles, you do have, the developers that are building in the space have a tendency to, some of them have a tendency to, take the path of least resistance to wealth, which is, tough to blame them. But oftentimes that's, a useless utility token, or, something that really isn't going to, expand the space at all. And so that's the challenge. And then you have these winters, right? These crashes and corrections that, last for a period of time. And the developers like Jameson, who are still kind of head down through that, it's really exciting to see what comes out of those winters and what blooms and blossoms. And it can be challenging in a decentralized arena to have any sort of opportunity for incentive like there is in a centralized ecosystem. And so sometimes that's why it takes a little bit longer than, say, the internet did.
Yeah, and you have to remember, we're only in the first 15 years since Bitcoin was created, which was the start of all of this. So we are definitely very much still at the beginning.
Exactly. I guess thinking a little bit about sort of family offices and how they begin to, manage this and keep an eye on the future, what type of indicators should they be thinking about in this current climate? Perhaps a question for you, Aidan.
Yeah, I guess we can just look to the newly issued ETFs around this space. I think that has been a massive success, at least from a flow standpoint. I think the BlackRock ETF just crossed 8 billion within the first three weeks or something like that the other day, which is one of the biggest success launches within ETFs ever. So I think there's definitely institutional demand for these types of products, and that is just going to fiddle into other projects within the crypto ecosystem and also within the blockchain community. So I'm super excited for this cycle, and we have Bitcoin above 60,000 again today. So So it feels like we're moving towards spring and a little bit happier days within the space.
Brilliant. I guess sort of I'll ask everyone this question individually and sort of go around, but what sort of excites you the most about this space today and why? So maybe starting with you, Jameson.
It's been the same reason for me for the past decade, which is that we are building open collaborative systems. The reason that I got interested in Bitcoin was because I felt like money is this abstract concept that it should not belong to anyone in particular. It should not be controlled by a small group of people. It really is something where we're all agreeing upon, what is the authoritative ledger of ownership of who owes who what. So it makes sense to me to be an open collaborative project where anyone who wants to can contribute to. And so that concept, this merging of the open source ethos into finance, is what has spawned this multi-trillion-dollar ecosystem. And I believe that fundamental concept is going to be applied to more and more things. And that's what we've been seeing over the past 5, 6, 7 years. So it's very exciting because I think that the potential for disruption is tremendous. But of course, it's going to be a very bumpy and volatile road along the way. And that's also why it's a very exciting space to be a part of.
Great. Perhaps over to you, Amila. What excites you about this space?
Similar to Jameson, I think for me, it's the unpredictability. The potential is huge, and the ability to create new things that no one's thought of before and do with cryptocurrency, digital assets, smart contracts. There's so much possibility there, and someone's going to come along, or a bunch of people are going to come along and do something that no one's ever thought of before, and the world could change because of that. And that's pretty cool, right? If you want to get philosophical about it, that's what excites me most, is the possibility and not being able to predict that from where we're sitting right now is pretty exciting.
Great. Perhaps over to you, Ben.
I think I'll take a slightly different angle. The freedom that these assets represent can really have a significant impact on humanitarian issues, and I think that's kind of an under discussed part of the value of this technology.
Perfect. And you, Aiden, what excites you about this space?
Yeah, I think I have a lot of personal reasons, which I echo all of the other panelists, and I totally agree with them as well. But I guess from an opportunity standpoint, or more from my position as responsible for alternatives within our family office, I see the continued growth and adoption of blockchain technology across various sectors very exciting. But within tokenization of real-world assets, I think it is super exciting. There's a lot of developments happening. We're still at the very early beginnings of this, but I think it can provide access and inclusivity for a lot of people to gain access to certain assets or allocations that they just simply couldn't before. And we can go this direction or not, but retail investors might actually be able to invest in startups that we've just never been before, because venture capital has so high both regulation demands, looking at the different jurisdictions, but also capital constraints. And this technology truly brings inclusivity to investments within alternatives as well, and that excites me a lot.
Brilliant. Well, that wraps up our panel event today. That was just the tip of the iceberg of the types of conversations that many in our network have. Thank you so much for carving out the time, Jameson, Amila, Aiden, and Ben. If anyone would like to reach out to any of you, I know that you're sort of open and welcome on LinkedIn, except Jameson, the best place to reach you always is casa.io. So if you're wanting to find out a little bit more about what it is that Jameson's up to, head over to that. But yeah, there's a lot of information out there with regards to digital assets and other themes related to family offices. And ultimately, thank you to the Simple team. And Simple is here to help sort of family offices explore, collect, and share relevant insights. So please feel free to reach out to any on the channel, email them, DM them, and ultimately, if you'd like to know a little bit more about Simple, it's a leading family office knowledge resource, providing a suite of technology-driven solutions to empower the next generation of family offices. It's a fantastic network to be a part of, so definitely check it out. Thank you so much, everyone, for your time today. It's been an absolute pleasure, and stay well.
Thanks, guys.
Bye.
Thanks, guys.
Thank you.